Welcome back to Beyond Four Walls, Conversations on Affordable Housing. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest affordable housing coalition. I'm joined today by Don Mullen, the founder and chief executive officer of Pretium, a specialized investment firm focused on U.S. residential real estate, including single-family rentals and build-to-rent housing, residential credit and corporate credit. Pretium's platform has approximately $60 billion in assets, comprising real estate investments across nearly 90 markets in the U.S. This includes 94,000 single-family homes under management. Pretium is also a leader in the build-to-rent space, having acquired 7,500 single-family homes built as rental housing. Before launching Pretium in 2012, Don spent over a decade at Goldman Sachs, where he served as partner, headed the securities division's global credit and mortgage businesses, and was a member of its management committee. Prior to joining Goldman Sachs, Don was the senior managing director and global head of credit at Bear Stearns. Welcome, Don. I'm so excited to talk with you today.
Nice to spend time together today. Thank you for having me.
So just to get started I like to give our listeners an opportunity to know more about you as opposed to what you do. So what's the most interesting and important fact about you that has nothing to do with your work?
Well, I have to say this is often the most difficult question people ask me because I don't really find myself that interesting. I'm often befuddled by this. So when I give thought to it, I think the important attribute is that I find insight and inspiration in weird places.
Well, give me an example of a weird place that's inspiring.
So I'm reading on Xi Jinping by Kevin Rudd. He's the former prime minister of Australia. And he gave a whole introduction in the front of the book and how the Chinese Communist Party uses ideology to inform and cause a large group of people how to think and analyze a problem in their insight, their way. And I was reminded how at corporations like Goldman Sachs and Bear Stearns, we tried to do the same thing.
Interesting.
That corporate culture has an interesting analogy, I thought, to Chinese Communist Party ideology. I don't think that would be a normal person's insight. So I think of weird stuff like that. So I look across odd data sets and come up with unusual conclusions. I'd also say most people who think like that aren't really excited to try to find the time to go to see Chapel Roan, right? Which also would put me in a category that's unique and odd. So,
well, there you have it. I definitely feel like I know you a little better.
Or I'm just odd.
You know, I've been called a lot worse, but odd definitely fits my persona completely, and especially out of the box. I'm sure we will. So tell me a little bit about how you found an interest in the housing and mortgage sectors, and I guess that started at Goldman and then evolved into this really interesting, assumed startup that led you to leave Goldman Sachs.
Sure. It definitely was a startup. So what happened was in December of 2006, I received a call from then President Gary Cohn of Goldman Sachs about wanting to reorganize parts of our securities division. And in that conversation, I told him that I would be happy to accommodate his desire to move some of the pieces around the chessboard as long as I ended up with the mortgage department at the end of the process. And he said, "We are bad at mortgages. Why would you want that department?" And I said, because there's early payment defaults in the warehouse lines of subprime mortgages. And that is such an unexpected event that you have people missing their first payments on mortgages, that something really bad is going to happen. And when really bad things like that happen, the structure of markets change and opportunity presents itself.
Well, were you in The Big Short, or did you successfully avoid getting in The Big Short?
I successfully avoided the book, the movie, but not congressional testimony.
Well, there you have it.
I didn't have to testify. They just read my emails live on TV.
Oh, well, okay. They did not read my emails. I was at Fannie Mae, and during the onset, I left in 2006, but I had the distinct pleasure of being on the last countrywide contract call.
Oh,
And
wow.
you want to talk about a bizarre and weird experience. Literally every
Sure.
single thing I'd learned you should never do was in that contract.
Yes, sure.
Okay, so now that you've triggered my PTSD, we'll move on to my second question, which hopefully will be less disturbing to me, but equally interesting. So, the 2008 financial crisis, the Goldman Sachs notably navigated through that mess better than almost everyone, including your previous employer, as an understatement. You decide to create this company to invest in these foreclosed homes, and foreclosures are growing dramatically during this period. As somebody who at the Treasury Department at the time was very focused on the growing number of foreclosed homes and the rapid depreciation of both the homes and the neighborhoods as a result of them being vacant. And one of the things that I worked on was pioneering the use of hardest hit funds to do demolitions. But the demolition is a sign of complete failure. And if we have a vacant and abandoned property in a neighborhood, one of the ways we were able to justify that was that that vacant property led to more foreclosures. And so filling those vacant properties was essential.
100%.
And so we reached out to a lot of people such as yourself and encouraged them to buy these. And I have to say, my belief at the time was this is an incredibly difficult business that almost no one is successful in, that your exit strategy is probably going to be selling into a rising housing market as we get out of this crisis. And then you guys will be gone. And wow, was I wrong? You all figured out how to do this business well, and frankly, better than anyone had done it before. And I want to understand a little bit about that early process, because was that originally your strategy, was just to sell into a rising housing market, or did you think, no, we can make these numbers work?
I think in the earliest possible days when I was buying houses with my personal money. So the first investments I made were to buy 100 houses personally without leverage.
Right.
So in doing that was an experiment. And I thought the exit would be selling the houses in the rising housing.
Sure.
Once having begun the process of analyzing the scale and opportunity, I raised a fund. At that point, I was very confident that we would go through a journey that was more similar to how multifamily from the 80s through the 90s and the early 21st century became an institutional asset class overall. It started its journey as a family, wealthy family kind of product, and ended up being in REITs and pension plans and insurance company balance sheets and sovereign wealth fund balance sheets. And I believe single family rental is on the same journey.
So the challenge is it's very hard to property manage widely scattered site single family homes because of the cost and the scale. And as with 100 properties, you're pretty much a classic mom and pop at that stage. What Pretium and a lot of other investors were able to do was succeed at using their economy of scale to solve for this problem. Tell me a little bit about that. How did you do that?
Well, I think we had an advantage in that era. I think if you had the same event occur in 1999, as an example, it would not have been as successful as it was in 2009. And the difference was the cost of technology had come down so dramatically. Your ability to build workflow platforms that moved an asset along like an assembly line, more similar to how Ford and GM made a car. Then for those of us old enough to remember Lucy at the Chocolate Factory, that's what we all thought it could be like, is Lucy at the Chocolate Factory, where it was too chaotic. And instead we were able to organize workflow, and the organization of workflow and technology really made a massive difference in the ability to do that. You also brought to bear the ability of strategic sourcing of products. So using one type of paint for every house, being in a position that you had one refrigerator, one HVAC unit generally. And so that sort of scaling event gave you a lot of value. The other thing that people underestimate is the fact that you're in a position that people, once they rent a house, have a predisposition to stay.
Yeah.
And an apartment, for many people, it's more transitional And for many people in a home, it's a longer stay. And so that gave you the advantage that while harder to manage in an apartment in some ways, the length of stay of the resident offset the complexity that took place on the turn.
Interesting. It's totally true. I mean, I rent a single family home from my mom and pop. My wife and I have both had many homes that we've owned. And when we got married, we looked at the numbers and said, you know what, in this market, it makes a lot more sense for us to rent. And we did. And we've had 2 houses in the last 12 years and have loved them. And I've been in my current home longer than I was in any of the homes I've owned.
Did you follow Bob Schiller's advice, though, and then put all the money that you would have used as a down payment into the stock market?
Yeah, that's worked out pretty well.
Yeah.
But it would have been worked out as well, I think, with housing values here. But every time I had to make a $10,000 repair and was able to do it by picking up the phone and calling somebody else to pay for it, felt pretty great. So you've got the benefit of the increasing sophistication and the lower cost of technology. You're building scale. What guided your sense of where do we want to be and how do we want to be there as you build this portfolio?
Well, if you go back to the earliest days in this, as you talked about, one of the things that's interesting versus now is as we were buying these houses, we had the neighbors more or less begging me to buy the house.
Yeah, definitely.
Because they were concerned, as you pointed out, that in many communities, houses were effectively abandoned, often were centers of crime.
Mm-hmm.
Of all the 100 houses that I bought originally, I walked every single one myself.
Yeah.
Because I wanted to beginning the process of pattern recognition, which is sort of my thing, as one might expect, looking from Xi Jinping to corporate culture at Goldman Sachs. I was looking for connective tissue about what made a successful one versus one that wasn't. And I remember walking in Riverside City and coming across a home that was for sale in bad shape and walked into it. And, it was clearly a place that people had been selling drugs from.
Mm-hmm.
Clearly had been a place where wild animals had been roaming because you could smell it. And the neighbors stopped me as I walked out very inconspicuously in my blue suit with my red tie and white shirt and stopped me on the street and said, please buy that house.
Yeah.
I was like, why? They go, if you buy that house and fix it up and rent it, the neighborhood will be better. And so in the beginning of this process, it was very clear that there was tremendous support in almost all of the communities for capital to enter. And that made it even more appealing, quite frankly, to be in a position that a business that we thought was at a very unique entry point, almost a once in a century type of entry point for an asset class.
Hopefully.
Yes. And we can talk about that. I think it will be. The combination of that and the combination of technology and the fact that people seem to have ignored that a demographic wave was at our back. Like the people who were living in that house who got foreclosed upon weren't going away. They still needed some place to live.
Right.
And we also had a sea of millennials starting to come through.
Mm-hmm.
So what I always find most interesting, and it's not just about single family homes, it's not just about demographic, it's writ large, that people tend to get caught in the headline of the moment and not do the research about the bigger picture. So there's a lot of noise today in the newspaper about home builder inventories and hangover of home builder inventories. And, everybody was moving to Austin, but nobody's moving to Austin anymore. But if you look at all the real data, the headlines, whether it's the Wall Street Journal or the New York Times, or pick your favorite communication device, Austin's still growing at one of the 4th fastest growing cities in America. Home builders still represent a very small percent of all homes for sale. Yeah, they've had to move to spec houses more than they did in the past because millennials don't care about having that house customized. If you look at Pulte zonings, for example, they talk about how the only people who really want to buy a house in advance and customize it are over 60. Everybody who's between 25 and 40 wants to touch the thing before they buy it.
Over 40, you know what you want.
It might have been longer for me.
Yeah.
It might have been longer. I didn't know if you were talking about houses or partners or...
Yeah, well, there's that. That's a whole separate podcast. But yeah, I totally get that. When we bought our first house, we were in our late 20s, and it would have been overwhelming to do a custom build. We couldn't afford one anyway. We bought a townhouse. And the big advantage for us was that my parents came and looked at one we were looking at and said, no, these windows aren't high quality, and see, this banister isn't solid. And we went to another development. They were like, yeah, this is it. And that was good enough for me.
Right?
Yeah.
Well, my parents definitely bought a fixer-upper.
Yeah. You learn a lot doing that.
Sure. We had the bathroom had no sheetrock in it for 2.5 years, but my dad was doing it himself.
Yeah.
And he went on strike in the middle of fixing the bathroom. So
yeah, that happens. Now we'll skip ahead because Pretium has been very successful. You guys have grown quite a significant book of business. We're in a different economic space completely. Housing prices are much higher. Interest rates are much higher. How are you navigating this space now, and what does it mean in the industry? And are we looking at shrinking portfolios? Are we looking at refining portfolios? How are you thinking about the market?
I think overall institutional investment as a percent of the single family home market is shrinking. I'm not saying the REITs are, I'm not saying we are, but if you look, there's numbers of our competitors who've left the field. So there's been a pretty consistent volume of medium-sized portfolios that have either been liquidated or consolidated into others. Some of that is the challenge of operating portfolios without having large scale. I mean, it does make a difference to have 50,000 houses versus 10,000 houses. It does make a big difference.
Sure.
Some of it is just the challenge that being in a position where there's a lot of pressure from institutions on the social side that somehow think that we are not representing residents or communities in the best way possible, which I strongly beg to disagree. That I think we continue as an industry to add more value, more opportunity to our renters. And I think it's unfortunate that they would rob renters of the opportunity to live in better communities with that kind of a program, but it's a tougher market for institutions. Right now, with the low yield, the wise investor, I would tell you, is much more the individual. Individual investors are growing their portfolios again. And so the growth in the category is not coming from institutions. It's coming from moms and pops again, many of which who sold out after COVID and are now back again.
That's interesting because one of the other factors in this is that the mom and pops have much less capital. They don't have the scale. And I always find it somewhat ironic when people say, oh, yeah, we need more mom and pops and less institutional investors. When you read, the book Evicted, for instance, that is the bleeding edge of mom and pop business models where, frankly, they're struggling just as much as the tenants.
Often. For us, what we see is not just in that circumstance, but operating a lot of assets in the Southeast and Southwest, we have to prepare for hurricanes and fires. And one of the things that I think having scale also lends itself to is we don't need to be in a position to wait for the insurance company to figure out what needs to be fixed. We don't need to count on local support to inspect our houses. We don't need people to call us. We go find them. And so one of the advantages of large institutions is we are a better partner for the communities during periods of crisis like that.
Interesting. Because you get compensated on the back end by the insurance company, but you can move cash in immediately.
Move cash and lots of staff, like baby FEMA. We have pre-positioned assets outside the ring of the expected hurricane target and then rolled them into the communities after events. So
can you give me an example of that recently?
Yeah, we pre-positioned people from all around their national network in Dallas. And when Houston got hit by hurricanes a couple years ago, we drove all our people in. And then when they were there, the goal was to be in a position first to count heads, make sure every single resident is accounted for, then do inspections and what repairs we can do. We pre-contract with contractors to do repairs. They don't need to wait for someone to get insurance proceeds, do the work, we'll sort it out. And we'll be able to stand up houses and get the least number of people dislocated. And if someone's dislocated, we will rent them a house or find them a spare. Mom and pop can't do that.
Right. They're waiting for the insurance company check.
They're waiting for the insurance company to come do the inspection.
Yeah. So I find that fascinating and definitely begs the question of insurance and rising insurance costs. NHC is putting together a residential property insurance collaborative because it's a crisis on many, many levels, for individuals, for lenders, for investors. Tell me about how you're dealing with the rising cost of insurance and what are you experiencing on the ground and how do you think about that from a business strategy?
Sure. Well, I mean, from a business strategy perspective, the first thing you need to do, obviously, is have a good balanced portfolio. Having all your assets in Florida or Texas would be horribly challenging. The second thing is we use a lot of data to identify where are safe places to put your assets. So despite the number of hurricanes and floods that have taken place in Florida, we've had very modest problems because we don't locate our stuff in the way of obvious trouble. And so that's helped significantly. Obviously, being as large as we are, we don't call Safeco and ask them how they want to insure the portfolio. We go to Lloyd's of London and then we create a waterfall. So we're advantaged versus the American consumer that we can structure a portfolio that gives an insurance company a tremendous diversification of exposure to an asset class they generally like. And they save a lot of money. I mean, one of the biggest costs for the average consumer, whether you're buying a house or buying insurance, is the commissions that you pay to the brokers are extraordinary. Obviously, we're eliminating the insurance broker in that conversation. So we're saving a lot of costs for the insurance company and ourselves that falls to the benefit of our investors and our residents. It's one of the reasons why scale at this size, whether it's buying fridges or buying insurance, allows us to rent houses at a price that in some cases is saving as much as $1,000 a month versus owning a house in some markets. It's a good value for people who can't otherwise afford to live in these communities and what we think are very attractive opportunity. We're very focused on communities that have low crime rates and good school scores, so folks can be in a position that they can get out of those communities that were high renter concentrated, which have less aspirational outcomes for their children very often. We follow Raj Jetty's work at Harvard, and he does a pretty good job on that.
Yeah. We talked about insurance. Another big driver is interest rates. Core inflation has been stubbornly elevated above the Fed's target. Interest rates, as a result, have as well. There's no shortage of opinions about that these days. Tell me about how rates where they're at now are impacting your decisions. And then as rates come down, because eventually they go up and down, how do you think about that?
Well, interest rates stretch across the board. And what I mean by that is interest rates affect mortgages, interest rates affects the price that a home builder pays, and interest rates affect the price that the guy developing a community pays to borrow money. So it trickles through the entire ecosystem. And so I don't think interest rates will come down sufficiently that we will see a release of the mortgage lock-in effect. And you should expect persistent, longer stays by people in their extant homes.
Yeah.
That combines with the fact that we already have a generational conflict in many ways between the millennials and the generations younger and the baby boomers, because the baby boomers are staying in houses way longer than their parents did. So you go back to 1990, people would leave a home they own at 60 years old, and now they don't leave till they're almost 80. So it's almost 1.5 million homes that normally would have been recycled to the next generation. That's not happening at this point. And so if you look, the impact of that, and by the way, they're buying more houses. So if you look at 2024, who were the largest buyers of homes by age cohort? It's people over 50. And it's one of the first times that first-time home buyers weren't one of the largest cohorts of people buying houses. And they're less interest rate sensitive, the older generation, because they have more wealth. So we will continue to go through a challenge that higher interest rates will cause a skew of home builders wanting to build for wealthier people and older age groups and less focused on accessible housing for people of, earlier in their life. That's not going to go away as a phenomenon in the short to intermediate term. I think we have less mobility. If you look at the data, it's not just mobility of people staying in homes longer. There's labor mobility is restricted in some ways by the mortgage lock-in effect. I think that higher interest rates means it costs more to build a house. And so if you look at the data, banks are leaving the category writ large for construction. The Fed has discouraged them from lending out outside their depository area. right? And in addition to that, there's higher cap charges. If Basel III went, there would have been materially higher cap charges. And so as a result, we see one of the most attractive things investors want to invest in is they don't want to buy houses anymore. They don't want to buy apartment buildings. They want to lend to the guys doing that because that's where you get equity-like returns, right? Without the risk. So quite frankly, it's an interesting phenomena that debt and equity are not far apart in returns. And that's going to stay the same for quite a bit because of the dislocation from the lender. And so in the short to intermediate term, I think that debt remains more attractive than equity. We'll probably see less construction go on, and we're going to hear the grinding of less housing affordability be more prolonged. Sorry for being so pessimistic, but
it is what it is. Tell me about trade, because we've got a really historic change in tariff regimes and how we think about international trade. You purchased 7,500 properties, maybe more at this point, that are built to rent. You talked about refrigerators and appliances and other things. Obviously, that's impacted by tariffs.
sure.
What's your experience with that? How is it impacting your strategy in build-to-rent space? And I don't know if anybody can predict what's going to happen in the next 6 months to a year, but what are you hoping for?
It's not no one being able to predict what's going to happen.
Yeah, that is the new normal.
Listen, the bulk, I don't think there's any place, if there is, there's maybe one place we make fridges in the US.
Mm-hmm.
They make them in Mexico, a lot of them, right? And so I think that appliances writ large for houses are very much at risk from tariffs. We'll put upward pressure on that. We know that Canada represents a meaningful amount of lumber, as people talked about when we went through the Canadian
Sure.
tariff discussion, which is not yet over. So tariffs generally put pressure. I don't think you've seen a lot of it in the system because we're dealing with the backlog of goods contracted before the threats and actual tariffs came in. But also where tariffs have come in, I think you've seen suppliers eat a third, the middlemen eat a third, and the consumer is saying like a 2 to 3% increase. But over time, these things tend to normalize, and the consumer's cost could be up 3% per year for 3 years. And then the whole tariff would end up being predominantly eaten by the consumer. And so all those things, again, go back to a continuing challenging environment for the first-time homebuilder cohort, the middle and lower homeowner cohorts, because they're already stretching with higher interest rates and higher house prices to buy a home. So, and if you look at the data on home builder sales, right, looking inside like what's selling and what's not, and everybody's talking about home builder inventory overhang, they're selling the big house. There's been no stop in markets where people think they're overbuilt in Austin and Phoenix and Dallas.
Mm-hmm.
The large houses are selling and they're not affordable, but the $250,000 to $400,000 house is the house that's not.
So how does that impact your acquisition strategy in terms of build to rent? Do you see that portfolio growing more as a result of this or less, or you're going to keep
We
it
do,
stable?
but we have to be really judicious. So build to rent is not a single category. It's a little bit like saying soda. There's orange soda, there's Coca-Cola, there's ginger ale. There's a lot of different kinds of build to rent, right? There's little like cabana style, low amenities, and there's increased amenities, and there's townhouses, single family with one garage, single family with two garage, and even like adjacent build to rent to ownership communities. Anything that has, we've experienced so far where it's more mixed between ownership and rentership in a similar community has been the best performing of the things we've seen. You get a real investment in the community by both the renter and the homeowners. That's where you get the best outcomes for residents. And so we're big fans of that. You have to be very selective when you're talking about build to rent communities in any of the other categories I mentioned, because siting is critical, adjacency to services is critical, the quality of the school that you expect to be built is critical. And then you look at what people aspired from, why your parents or my parents wanted to own a house. It wasn't just really the ownership, at least with my parents. My parents wanted to live in a place with good school. They wanted to look for the place they could afford because it was a rental desert. There was no place to rent in the towns we looked at when I was a little kid, but you could buy a house. And it was the school, how far from the school were we, and were my kids safe? That was the predominant driving principle. And so being in a position that you can provide that without ownership is a unique thing of this era, a new thing of this product. And we look for that in BTR communities. Are they in areas that provide that kind of service to the residents so that they can get the outcomes that we still think people are focused on, which is, can I raise my children in this place that gives them the opportunity to succeed?
So let's pivot to artificial intelligence. Pretium was, I would say, a leader and pioneer in this space. It's fair to say you really started the firm founded on the use of technology. AI comes in, machine learning. You all have incorporated that in some really interesting ways. Tell me a little bit about how you have leveraged and used AI to enhance your decision-making in acquisitions, but also how you manage your portfolio.
Sure. So I think that, first of all, as much as people have some concerns about how AI will affect the jobs market, we will tell you that residents that we've worked with on this love it, because the advantage of AI is it's willing to communicate with you 24/7, 365.
Mm-hmm.
And the bulk of people have been trained in the purchase or application for things by Amazon. And they want to be, or Uber Eats or anything like that, where they can text complaints or get a refund via an app or an email very quickly. So the entire real estate industry remains lagging the consumer products industry in this concept. But what we have found in testing it is that people are very enthusiastic about being in a position that AI, and this is not general AI, this is AI that not too long ago we called machine learning, but you just don't get as good a multiple on it, right? So AI really helps them execute the paperwork, the approvals, and helps answer questions anytime they need to reach out. And we can use that both for our applications process, but we can also use it for maintenance requests from people. And then obviously, being even more scaled up is to start to drive correlations across the whole portfolio by having all our operating data resorted by Palantir and then put into AI helps us do better preventive maintenance and more efficient versions of that. So I see the whole industry moving in a more predictive way to drive efficiency. And that efficiency, I think, works very well to the advantage of the resident and the investor.
So as an investor, I really get the value of AI and its application. There's a lot of inputs. You tell it what you want. You go back and forth around basically having a technical conversation with it around what it's recommending, where, how much. It can inform your choices. But in the property management space, I think it's really interesting in terms of both interaction with the tenant. We talked a little bit about that, but even in terms of what goes in the maintenance truck every day and how you address that and reduce your cost. Can you tell us a little bit about that? Because I found that really interesting.
Sure. Well, I mean, the most effective way to run a maintenance truck that we have found is have it occupied with the most commonly used parts.
Mm-hmm.
That the truck is a smart truck, so it can effectively reorder what's missing, right? And then use the logistics chains that's pre-existing, either FedEx or UPS, to reload your truck at the home of the maintenance man. So that's a big change in the way people think about things and more efficiency in there. But by also being in a position you're constantly collecting data on everything that you repair, the age of what you repair, right? How many hours it's expected to work, puts you in a position that you can pre-position inventory, be in a better position to do strategic purchasing, as well as be in a position that, again, that when you're into a house, you can expect that you should expect these three things so that the person doesn't have a problem later. You can hopefully be in a position to replace something before it needs to be repaired. Because a lot of times, quite frankly, it's cheaper for us to replace than repair, and it's cheaper to replace early than it is to make a second.
And the AI helps you understand exactly when and where that's true.
Trust. We're in the earliest days of that, but it'll go very quickly because it's just about data collection.
So tell me a little bit about how you see the evolution of AI in this space 3 to 5 years from now. What's the future look like for, and 3 to 5 years is distant future when it comes to AI, given the velocity that it's been evolving?
So again, we won't need general LLMs. We will use specific LLMs that can communicate with our investors, that continue to be in a position that we're answering most of their requests at higher speeds and effectiveness. And the reason I think that's important is it's not just the asset, which we want to do well, but increasingly we're in a consumer product and we want to strive for the most effective capability of deriving a experience for our residents that they feel they're very happy to have. And whether that's a Section 8 voucher holder, whether that's workforce housing, right? We want to be in a position that people feel like they got good value for their rent. And so that's a critical component. And I believe the efficiency that we get out of AI will help drive that to the benefit of all three constituencies here: the property manager, the renter, and the investor. And that will also put us in a position. And perhaps this might be the part that would make people anxious. The more we're able to drive efficiency, the more aspirational communities we can buy out.
Yeah. There's a lot to be afraid of. There's no question about that. But
well, some owners don't like renters in their community. And
well, that's a whole nother story for sure. But in terms of the AI, there's a lot to be concerned about, but the efficiencies and effectiveness and the cost of not adopting it is much higher than, I think, the risk of adopting it. You're either on this train or you're not, I think.
Well, I think that's true. But independent of whether you like President Clinton, right? The 1990s were an era of great labor productivity.
Yeah.
And if you draw a map and you just went to your Econ 101 class and said, what are the things that can help this country be in a position to deal with all the challenges it has? Improving labor productivity is one of the easiest things to deal with the budget deficit, because it ends up that taxes will go up without having a burdensome impact on anyone. We don't have to have a fight over income distribution if GDP per person is going up and therefore tax revenues are going up, right? That's a great outcome. And so labor productivity is one of the most important things. If we're not growing our population, we need labor productivity. If we're in a position that we have a high level of people aging, we need labor productivity. And AI maybe just came around at the exact time we needed it to be in a position to drive labor productivity, help balance the government, help be in a position that we grow GDP and bring hopefully more people to middle income. And we have a burden as a society to work on that. We haven't always done a good job, but we should be more keenly focused on it.
Yeah. Managing the dislocations is going to be hard because they're going to be popping up in different areas at different times and at a very fast velocity. And we're generally not very good at that. But there's no question that, this is going to have a huge impact on productivity. We've adopted AI as a small nonprofit, and we've already seen that, and are just scratching the surface.
I agree with you.
So listen, this has been a fascinating conversation for me. I know I've learned a lot, and I really appreciate it. I appreciate Pretium being a member of the National Housing Conference. You're part of what makes us the broadest affordable housing coalition in the country. And you guys have really been not just interested in our success, but in the success of our members. And I know you've made investments in some of our members in communities like Atlanta, and that means a lot.
Well, as we feel a high level of loyalty to Atlanta, they've been very good to us. The mayor's office has been very collaborative. We have worked on projects like Forest Cove, which is a big challenge for the city and the federal government, and helped relocate 40 families. We've worked actively with the police departments there, and we're able to help 34 officers get housing. So we're very focused on working with the communities that we currently own houses in, and we hope over the course of time to expand it to more of the communities. But Atlanta is something that's very close to us because they've been a great partner, and we have a lot of residents there. So we want to make a big investment in the community. But you'll see us to reach across the country, both on housing vouchers, do that, and increasingly we're investing several $1 billion a year in home building, lending to builders, let alone the equity that we're putting in. So that's another billion plus dollars, we're going to be an active member of many communities across the country.
Well, that's fabulous. And we actually are just starting a project to use AI to reform the Section 8 housing choice voucher regs, and we'll definitely be talking to you about that.
We'd love to. It couldn't get more complicated than it is.
No, that's for sure. But let's see if we can get that cost down and the barriers to entry down. So, well, hopefully you'll have more competition, I guess.
Listen, my view about this is I don't view it as competition. And let me say why. We are such a small percent of the universe as an institution in the single-family rental space. I think the more people that come into the space, the more liquidity it'll provide investors, the more innovation that will take place, the more competition, so it services the resident and the investor well. I embrace the institutionalization and the growth of the category, and I think that's good for everyone.
Terrific. Thank you so much for joining us. I've learned a lot and I really appreciate it.
All right. Nice to spend time together. Anytime, I'm available.
Okay. Take care.
Thank you.
Bye. Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.